Buying a house is one of the most exciting times in your life, but also going to be one of the most confusing topics to talk about buying a house: closing costs. Today, specifically, I'm going to educate you on a discount point. What is it, how it can benefit you, and thoughts for you to think about. Should you not buy down, including a few alternatives to buying down your interest rate. So let's dive into it. Hi, I'm Ray from Mortgage Advisory Group here in Denver. I have another video for you that you might want to check out that goes through a loan estimate top to bottom so you can understand the confusing topic of closing costs on a more macro level. Today, we're just talking about discount points, and let's dive into first, what is a discount point? It is an additional part of the closing costs, a fee that you would pay in addition to your closing costs to buy down permanently your interest rate. As an example, you'll see here shortly, I'm going to use a $530,000 loan. So it'd be the equivalent on average of 1% of fee, $5,300, to obtain a permanently lower rate. Okay, so when should you think about buying down the interest rate? Timing, I think, because you have to look at rate cycles. Going in through COVID, rates were coming down. So buying down your interest rate wasn't a smart play at that time, though a lot of people hedged and did because they thought, well, rates just can't keep going down, and they did. So that would have been fool's gold, money thrown at loans where rates ultimately could have been refinanced before the financial decision made sense with what I refer to as a break even. In this cycle right now, with rates staying stubbornly higher, as I'll show you in a minute, it comes down to a cash on cash investment on a number of months. Don't get emotional about your interest rate. Look at the financial decisions behind it and decide for you if it's a right call to buy down the rate. Other things, how long you might keep the loan, but that rate cycle might be the biggest thing. If you think rates are going to come down in the next handful of years, I honestly would tell you, stay away from buying down the rate. If you're not going to keep the loan, stay away from buying down the rate. Some other alternatives to buying down the rate, and then I'll dive into the live example. And within that, I'll go through that. But one of them is take the money you would pay to buy down the rate. In this example, a $530,000 loan, $5,300 is 1% of the fee. Put that in an online savings account. You can draw money every month to subsidize your mortgage payment. It's the same as buying down the rate until you exceed that break even. So that's an alternative to buying down the rate. So let's talk about this. So real quick, pause with me. I'm going to share my screen, okay? And what I'm going to show you is, in fact, the financial model with some education about buying down the interest rate. So what you see over here is the example of a $530,000 loan. If that rate were 6.5% and you paid no discount fee, no points, principal and interest $33.49. This is all about principal and interest, everybody. From there, historically speaking, I could tell someone on average, you might pay 1% in fee, 1% of the loan amount, $51.30, and the rate would permanently become 6.25. To me, it's just math. I'm going to save $86 a month because my principal and interest went down to $32.63, but I paid $51.30 extra at closing to do that in straight cash. That's 62 months later. Did it make sense for me? Would that money have been better served for me elsewhere? What's going on in the interest rate cycle? Will I have that loan more than 5 years? If the answers are no, and rates could come down, keep the money in the bank, invest it elsewhere, maybe put it into a bathroom to increase the value of a home. Hypothetically, not commonly achieved, but if you could do the same thing and pay 1% and save half of 1%, well, now we start to have an interesting conversation, because that break even with that $172 a month saving is 31 months. Back to those things. How long before rates come down, etc. So past that, I'm going to share with you what I just talked about, the possibility to the alternative. Here's another alternative for you. That's 6.5, but what if you instead, the 6.25 at 530,000, kept the 6.5, but now you only borrowed 525. So you did not pay the discount point, but as the example goes, you would actually have a principal and interest. You would gain $55 a month versus the person who financed less at a higher interest rate. Now the break even is 94 months. A little bit of a brain twister, everybody. So when you're thinking about should you buy down, should you not buy down, there's a lot more that goes into it than just what the savings is. You should be getting sage advice about rate cycles and what's going on in your life. And where could the money work for you? If you're buying your first house and needs improvements, can you swallow the higher payment but increase the value of the home and feel better living in your home, growing your wealth in that vertical? So I hope the topic of understanding discount points is helpful for you today. Drop some comments, watch some other videos. If you find these authentically educational videos to your liking, subscribe to the channel. We'll drop some more here soon for you. Talk to you again.